everybody. It's Jessica Stone at Stansberry Research, and I'm joined now by Bill Shaw, the editor of Stansberry Gold and Silver Investor. And Bill, we're in the middle of what's looking like a gold rush. You really closely follow gold mining stocks. We're certainly seeing a spike in prices on gold bars. Are we seeing the same happen in mining stocks as well?
We haven't so far, but I expect to see that shortly. With all the things the Fed's doing, this environment is good for gold bullion, which is a good place to store your wealth and preserve your purchasing power in these uncertain times. But as gold prices rise, these companies will do better. So far this year, they've been kind of flat, while gold's up about 12%. But once these miners have sales of this gold at these higher prices, it'll start reflecting in their earnings reports and their balance sheets, and we'll start to see them take off here probably by the end of summer, I would expect.
Okay, and you kind of break down the kinds of gold mining stocks into four buckets. How are they most likely to do in this kind of environment, and what are the pros and cons of those buckets?
I would say royalty and streaming companies are the least risky way to play rising gold prices. These are companies that lend capital to miners in exchange for a future portion of their royalties. It's often very tough for miners to get funding because it's a very risky business. It takes a lot of capital up front. They're often located in risky political jurisdictions. So banks don't like to give money to these guys often. So enter the streaming and royalty companies. They'll give you the money that you need, and then they'll take like 2% for the life of the mine. And it takes some time for these companies to grow and build up a portfolio of stable assets. But if you buy one of the bigger ones, they're very, very safe way. Even during down markets in gold, these have traditionally performed very well. Those are companies like Royal Gold or Franco-Nevada, the first one in the space. So look at those if you're a first-time gold investor. The next bucket would be the major producers. These are really large, multi-billion-dollar producers that typically produce over 1 million ounces of gold. Companies like Newmont, they're the largest producer. Barrick Gold, the second largest producer. These companies have world-class assets. They're large, they're low cost, they have decades of reserves left in them, so they've got a lot of safety that way. Now, the downside for these, the upsides they're very safe relative to other miners. The downside is they can't grow as fast as some of the smaller miners because they're already so big that they can't buy a little tiny mine here and there. They need to buy a very large asset to really move their needle. The next tier down would be small producers, intermediate producers. Might produce a couple 100,000 ounces a year, might have a couple good assets. This is where you have to start doing a lot more homework.
Okay. Like what?
Well, I like to go and meet with management for one thing. I think that's really important. You got to separate who's making good decisions. You look at their track record. You look at their balance sheet, and you look to see, do they have enough money to make a good acquisition? Do they have nice assets that they could grow organically with more drilling? There's a lot of things to look at. So it just takes more homework. But if you pick the right one, you will see much better returns over time than you will with picking a royalty company or a major, if you pick the right one. Going further down the risk, the bottom level would be junior miners. And these are guys that don't have any revenue at all. I mean, They are looking to develop a mine or develop a deposit. So they're asking for money based on their knowledge of a hole in the ground, I guess, for lack of a better way to say it. But it's tough because it's hard to tell. Even geology is not an exact science. No matter how many holes you drill, you make Swiss cheese out of a rock, but you won't know until you actually try to mine at what you've got. So it's always a risk. With these, I would recommend first finding someone that has proven reserves defined versus a pure explorer. But there's really no safety with these. The pros of owning these is if you do hit one, it's like getting a lottery ticket. You can get thousands of percent higher. You can go, many of these trade for pennies. So folks that like to gamble, like to buy these stocks, they might put, They might take 10 grand and put 1,000 in each, and maybe one of them takes off. But I wouldn't recommend if your buddy tells you about this great junior miner, or you see an advertorial in some website, proceed with caution.
If you'd like to see much more content just like this, you can subscribe to our YouTube channel. You can also find us on Facebook, Instagram, or Twitter. Thanks for joining us. That's all for now.